Great to be back with you, and great to have you come back and join me for some thoughts on what's going on in the world of finance, the financial markets, and of course the U.S. and the global economy. These are really difficult times. They're difficult times because there's so many questions and so few answers. But I think the most important thing for everybody to keep in mind is, first of all, take a hard look at the financial market performance, and then take a hard look at the important economic variables and ask yourselves, how do they add up? Do they tell us that we've got further to go in what's already been historically a very long stock market, economic, interest rate cycle? And this currently at 113 months is the longest cycle we've had in the post-war period from the point of view of the duration of the bull market. It's not the strongest. Actually, 1990 to 2000 was a much stronger bull market, 399%. This one's only 311%, but by any measure, obviously this thing has been very long, and you have to be on your toes looking for those signs that say this cycle is over, as invariably it will, sooner or later it will end. But looking at the financial markets, look at the performance of the financial markets. The stock market is up. Investors have been buying the so-called bull market or economically sensitive sectors of the market. Small capitalization stocks have been outperforming large capitalization stocks. That doesn't happen unless investors collectively are somewhat optimistic about prospects for the economy and earnings. Earnings is a very important part or piece of this puzzle. And of course, if you look at the economic variables, leading indicators for the economy that tell us where the economy is going, not where it's been, very important to look at those. They've been up 25 months in a row. 2 months they were unchanged, but they're basically telling us the economy is going to continue to expand through 2018 and 2019. And along with all of this has been the real story of this bull market, and that's been earnings. This looks like a year in which earnings are going to be up 20%. I can't tell you how big a number that is. That's a really big number. It's driven in part by tax cuts, but nevertheless, U.S. companies are doing very well competing around the world. So it's all been pretty good news, and it's all been reflected in the stock market, which continues to move higher. And it's not as though we're not on our toes. I tell you that every time, that we're going to be on our toes looking for those signs that tell us that we're at the end of the cycle, but we currently do not see them. A couple of things that I'll just mention is that, first of all, one of the questions that comes up is, well, look, Mr. Johnson, what about the yield curve? It's just about to invert. This is pretty technical, and therefore it's signaling that there might be a recession not too far down the line, if indeed it does invert. A lot of the measures that are talked about in the yield curve are, quite frankly, not valid. The measures of the yield curve, measuring at the 10-year Treasury to the 2-year Treasury, 30-year Treasury to the 5-year Treasury, all technical stuff, and I looked at it very closely on a historical basis, and that stuff just doesn't work. It is true that the 10-year Treasury less the 90-day bill, or the 10-year Treasury less the federal funds rate, does work, and it's telling us that, yes, indeed, the chances or probability of a recession starting 12 months from today is getting higher. It's up around the 13% level, but it's nowhere near the level at which we should be really alarmed or really concerned, which, say, for example, it was at 40% at the beginning of 2008, the last financial crisis. So the point is, that's one question about the inverted yield curve. I'm asked almost every day about the chances of a global trade war, and I say to everybody, there's always the chance of a global trade war, and that would have a significant impact on the global economy and the U.S. economy. But when I take a look at the forecast of the IMF for the global economy, it's 3.9% this year, 3.9% next year. They're concerned about a global trade war, but they keep their forecast roughly at what they were. So keep that in mind. The second thing, as I mentioned, look at the performance of our financial markets. They've been positive, and they've been telling us basically that the U.S. economy is going to continue to expand. They wouldn't be sending that signal if we were in for a big trade war, and it's very important to pay attention to what investors collectively say. And then the third thing is earnings. I look at the forecast for earnings based on a lot of the earnings conference calls that we've seen for the second quarter, and that's really interesting. I mean, earnings forecasts for the remainder of 2018 and 2019 are going up, not down. This is not the stuff out of which you'd say that collectively economists and investors are giving us a signal that we should be worried about a trade war. They're saying a trade war is not going to, all the rhetoric is very noisy, but it doesn't look to me as though we're going to have a global trade war yet. there's still a ways to go before we could reach that conclusion. So the bottom line is that we're still maintaining a meaningful allocation to equities on the fixed income portion of portfolios, keeping a low duration because we think interest rates are going to be headed higher. We think the economy is going to continue to expand through 2018, 2019. It's going to slow down in 2019, slow even more 2020, but continue to expand. That's good news. Inflation's going to be a little bit higher. The Federal Reserve is going to respond by raising interest rates, and that, of course, will be coupled with other interest rates across the board going higher, but all in the context of rising stock prices. Not major rises in stock prices, 8%, 7%, that type of thing, but right through 2018, 2019, and with a little luck, 2020. The time I'm going to get concerned is when we get to interest rate levels in the later part of 2019 and 2020. Then I think we're going to have a real challenge with the current cycle. But between now and then, I think things are going to be okay. Stay tuned. Stay tuned to these market minutes. We'll keep talking about what's going on. And believe me, if market performance changes, if the economic variables performance changes, we're going to start to change. That is, we're going to reduce our allocation to equities. A lot going on. I really appreciate the confidence you've shown in us, and look forward to talking to you in the future. And as I've always said, and I really mean it, it's important that if you have any concerns, questions, worries, just pick up the phone, give me a call, give anybody here at Hugh Johnson Advisors a call, and we'd love to hear from you. We'd love to talk about some of these very, very important issues that are going on today. A very volatile, difficult period, but nevertheless, we're getting through it real well because we're sticking with our disciplines. Again, thanks very much for your confidence.